Is NVIDIA a buy or a sell? Let's get started with the model. This is a large cap company, 3.6 trillion market cap. They're trading at 147 a share, and they have 25 billion shares outstanding. NVIDIA provides advanced semiconductor chips. They're a fabless company. They design the semiconductor chips and outsource the manufacturing to a foundry. They outsource many of their chips to Taiwan Semiconductor, the largest foundry in the world. NVIDIA is the largest in the world in terms of market cap. They were founded in 1993, headquartered in Santa Clara, California. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow in 2021, $8 billion. It fell 50% to $3.8 billion in 2022. Then skyrocketed up 600% to $27 billion, doubling to $56 billion in the trailing 12 months. Phenomenal growth. Net income is the profit or loss on the income statements, revenue minus expenses. Similar trend. It drops a lot in 2022, up nearly 600% into 2023, more than doubling in the trailing 12 months. Revenue is a sales for the company, and that looks amazing. It was flat from 21 to 22. It more than doubled into 2023, almost doubled into the trailing 12 months. How much can they keep growing? They may be the biggest company in the world, but they pay the smallest dividend in the world. Of all the companies that pay a dividend, they pay the lowest, 0.03%. And they could easily cover that dividend payment. They could cover it 52 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 3.3 trillion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $2.9 trillion. We divide that by 25 billion shares. And we got a calculated stock price of 117. They're trading at 147, so they're trading at a 25% premium. It's a sell according to the model. The stock is always overvalued, but it keeps going up. So don't listen to me, just buy the stock. There are 64 companies in the same industry as NVIDIA, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They do spend a good amount of CapEx, $2.4 billion. Intel spends the most, $25 billion. Intel spends more than Taiwan Semiconductor. They have a good debt-to-equity ratio, 0.2. That means for every dollar of equity, 20 cents of debt. They pay a really small dividend. Most companies pay a dividend in this industry. United Micro pays the most, 6.6%. They generate the most free cash flow, double Taiwan Semiconductor. The only negative is Intel. Of course, they're the biggest company in the industry since they're the biggest company in the world, 3.6 trillion. All their price multiples are worse than the median. This should be red, this 31.8. Their price to free cash flow and price to sales are better than the average. They generate the most revenue. Taiwan Semiconductor is number 2 at 84 billion. Their 5-year annual revenue growth rate is 62%, the highest on this list. And look at their 52-week low, 46. 52-week high, 149. If you put $10,000 into this company 10 years ago, you'd have $3 million today. Most people aren't even worth close to $3 million. And just a bet of $10,000, which isn't a ton of money. I know for a lot of people, $10,000 is not chump change. But if you're working, $10,000 probably wouldn't break you. And with that small amount, you could have been a multimillionaire. If you held out for a decade, most people can't hold that long. And when your $10,000 was $300,000, you might have sold out. And if you didn't sell, it would have came down to $100,000, and you would have been pissed you didn't sell at $300,000. So you might have sold when it came back to $300,000 because you don't want to risk it coming back down, but it just kept going up. So to summarize, I have them trading at a 25% premium, ranking 7 out of 10. Would I buy it short term? 6 out of 10. I still think it's a decent short-term bet, but I wouldn't buy it. It's just so hard to buy it now after all this upside, but it never seems to come back down. Long-term, it's a great investment, 10 out of 10. Ratios are pretty weak. They seem really overvalued according to the ratios, 3 out of 10. Financials, it really doesn't get much better than this, 10 out of 10. Let's go through their most recent 10Q. They just released earnings this week. Revenue doubled, $35 billion for the quarter. Last year, $18 billion for the quarter. Let's get a breakdown of the revenue. Of the $35 billion of revenue, $15 billion is in the US, $7.7 billion in Singapore, China, $5.4 billion, Taiwan, $5.2 billion, and other countries, $2 billion. It's up in every single category. Here's another breakdown of the revenue. Of the $35 billion, $31 billion is data centers, And they break that down, 28 billion compute, 3 billion networking. Gaming used to be their biggest, now it's 3.3 billion, up a little bit from last year. Professional visualization, $500 million. Automotive, 449 million. And then OEM, a little under 100 million. Data centers are driving this company. They have amazing margins. Their gross margin is 75%, so they convert 75% of their revenue to gross profit. Let's go back to the income statement. Below revenue's cost of revenue, these are all the expenses directly tied to generating the revenue. Revenue minus cost of revenue is 26 billion. That's their gross profit margins. They convert 75% of their revenue to gross profit. Their operating expenses are R&D 3.4 billion, SG&A 900 million. So total operating expenses 4.3 billion, operating income 22 billion, more than doubled from last year. They receive more interest income than the interest they pay in their debt, so their net income is 19 billion. Last year, 24.7 billion shares outstanding, now 24.5 billion. Let's look at their balance sheet. Current assets 68 billion, current liabilities 16 billion. So their current ratio is about a 4. They can cover their current liabilities with their current assets 4 times. They have nearly 40 billion of cash. Marketable securities is considered cash. Accounts receivables, how much other companies owe them when they sell on credit, 18 billion. Their total assets 96 billion, up from 66 billion. Total liabilities 30 billion. Their biggest liability is long-term debt, 8.5 billion. Here's a breakdown of the long-term debt. The interest rate is between 1.55% and 3.7%. Assets minus liabilities equals equity, 66 billion of equity. They raised 12 billion from selling their business. They profited 54 billion from running their business. Retained earnings is a sum of all their prior net incomes. Let's look at a statement of cash flows. This is for the trailing 9 months. Operating cash flow tripled, 16 billion to 47 billion. Operating cash flow is less than net income, because it looks like they sold a lot on credit, 7.7 billion. When they sell on credit, when they use accounts receivables, it's a cash outflow in that accounting period. They also bought 2.4 billion of inventory, that's a cash outflow. In their investing section, they spent 2.2 billion in CapEx, a lot more than last year of 800 million. In their financing section, they bought back a lot of common stock, 26 billion, last year under 7 billion. They gave employees 5 billion of stock, and they paid back 1.25 billion of debt. Last year they paid 300 million of dividends, this year 600 million. Let's see what they say about their earnings results. The stock seesaws following earnings beat. Strong outlook as age of AI is in full steam. They beat the revenue target, analysts expecting 33 billion, they reported 35 billion. And the forecast for next quarter is 37.5 billion. Wall Street was expecting 37 billion. Here's a chart of their quarterly revenue since 2022. It started really taking off in the second quarter of 2024. You can see in 2022, they had more gaming revenue for every quarter in 2022. Then data center revenue took over. Now it's mostly data centers. And they quelled concerns about slowdowns in the availability of the Blackwell chip. And there's concerns about the future with this company now with Trump in the House. He's threatening tariffs which could affect this company. Tariffs are taxes on goods when exporting products. So a country may impose tariffs on certain products that are imported from one country into their country. A tariff can be a trade barrier because if there's extra taxes on a product, people are less likely to buy that product, or if they do buy it, they have to raise the price in order to compensate themselves for the extra cost. He plans to raise tariffs on Taiwan-made chips. So chips made in Taiwan shipped to the US will have an extra tax. And the vast majority of NVIDIA's chips come from Taiwan Semiconductor. Let's look at a stock on Simply Wall Street. Its last price, 147, 3.6 trillion market cap, flat in the past week, up 200% in the past year. This is stock price since it started trading in 1999. This is stock split adjusted, so it does look like 4 cents. And it did have a nice run up in 2018. Then it fell in 2019. You could have got it in 2019 or 2020 for $5. It ran up to 31 in 2021. Then over the next year, it really struggled. It came down quite a bit, and people thought NVIDIA was done with. And then the huge surge. It just pretty much never came down. There were some dips, but the dips didn't last too long, maybe a month or two at most, and they kept climbing. Simply Wall Street's valuation is 109. They say the stock is 34% overvalued. 52 analysts priced this stock at 170. They say it's 16% undervalued. Here's their revenue since 2014. It was $4 billion, and then it ran up to $12 billion, so it took a while to triple. Then over the next year or two, it was pretty much flat. And it did grow nicely from 2020, $13 billion, to $30 billion in 2022. It actually came down a little bit to $26 billion in April 2023. Then it just took off like a rocket ship. Not many companies break $100 billion of revenue for a 12-month period. They're one of the few. Their yield was almost 2% in 2015, but they don't raise their dividend even though the stock keeps going up. So that's why the yield has come down a lot, and it's only 0.03%. Actually, I'm wrong. They did raise their dividend. In March 2024, it was 0.004 cents per share, and they raised it to 1 penny. The CEO's salary is around $1 million. Total compensation, $34 million. Tenure as CEO, 32 years. The insiders don't have faith in the company. They're selling, only sells, no buys. You can't blame them. They want to take in their gains. They work hard for that money. Almost 10 million shares were sold by insiders in the past year. 66% of the company is owned by institutions, 30% by the general public, and 4% by insiders. Vanguard is the biggest shareholder, close to 9%, then BlackRock, State Street. The CEO owns 3.5%. His valuation is $125 billion. And their employee count has gone up a lot from 8,800 to 30,000. And the ticker trades on the NASDAQ, London Stock Exchange, Xetra, Deutsche Börse, Mexican Bolsa, the Bern, Borsa Italiana, Wiener Börse, Lima Bolsa, Bulgaria, Kazakhstan, BATS Europe, Warsaw, Santiago, Colombia Bolsa, Buenos Aires, Sao Paulo Bolsa, and the NEO. So if you want to learn how to build a discounted cash flow model, just watch this video. I'll even email you a free copy.